Martin McGrath. Today on the show, we're answering some Q&As out of the Facebook group. We have not done it this year so far, so welcome back to the studio for 2026.
It feels like it's been a little while. I was here for the Chrissy party, but it's looking fresh and clean and looking good. Keen to jump into it.
Love it. Hey, Ron said, am I thinking right? I have an investment property and I wish to sell it and move proceeds into my and my spouse's super funds, and then move our funds into a pension stream. Will those funds still be classified as an asset by Centrelink? So there's a couple of things going on there, and I just wanted to include this just as a bit of housekeeping teaching, particularly around what Centrelink say is an asset. Can we move money from the sale of a property into super? Can we save tax? Yeah. We don't know Ron's age. No. We don't. Do you want to assume an age for answering this, or does it not?
Well, and assuming Centrelink, let's assume Centrelink means the Centrelink government age pension, which typically starts at 67. So I'm assuming Ron and spouse are over the age of 67, but Centrelink could be other unemployment benefits under 67. So
we'll assume not unemployed benefits.
Yeah, so therefore we're in Centrelink focus. Will it be classed an asset? Short answer, yes, it's an asset. Now, is that good or bad? Well, it is what it is, but arguably once you're over 67, let's say we're both over 67, whether I've got, we don't know the value either, let's call it 500,000. If I've got 500,000 in the bank, 500,000 in investment property, or $500,000 in my super income stream, Centrelink is still counting it as 500,000 in every scenario in that case.
So the question I would probably ask you then, what are the key things that Centrelink do not deem as an asset?
Yep.
Is there like black and white, these 5 things Centrelink will ignore?
Yeah, biggest one and often the biggest asset people have is their home, principal place of residence. So if this is the case of Ron selling home, that would be different, but he's already said his investment home, investment property. So principal place of residence is not counted as a Centrelink asset in most cases.
Yeah. The other side of the not most cases, are we talking about farms?
Big land sizes, those kind of things.
And is it still under 2 hectares?
Yeah. So, and then above that, it's only the proportion that's above that, and it's what is the value of that land, and so
the usable portion,
etc. So there's an assessment. So just because it's 5% above it doesn't mean you completely ruled out. Probably is no material impact. So that's your biggest one. If you've got a funeral bond and you prepaid your funeral, those kind of things, they are exempt assets as well.
Now, and that's the dance, right? Is there an actual limit to the amount of bond? Because you're not going to go, I'm going to put $500,000 in a funeral bond, and then whatever's left over my
estate enjoys.
Estate can have tax-free.
Yes, there's a limit. It goes up every year from Centrelink. At the moment, it's around $16,500 per person.
Yeah.
So as a couple, that's a decent amount in some respect to have in there.
Yeah.
But the way that those things are set up is that it's not accessible for you. That if there's money left over once you're gone, sure. But it's not like, I'll park it there and I'll pay for a holiday in 5 years' time.
And then change my mind with the funeral home or a prepaid funeral.
So once it's in there, it's locked away, but therefore Centrelink say, well, you can't access it, so we're not going to count that. They're the biggest ones. Your car, all those contents there included. The other biggest thing I would say is super in accumulation phase when you're under 67. Now, slow that down on purpose and specified it because money inside of super, if you're under 67 or your spouse is under 67, that does not count as a Centrelink asset as long as it's in what's called accumulation phase and not as an income stream.
Yeah. I mean, the fourth one is a bit of both, and I don't know if you know where I'm going, but annuities.
Yeah, so different type of investment product is, and that's often a partial amount is exempt. So if you move some money into a lifetime annuity, typically the day you set that up, 40% of that is exempt. And then later in life, it drops down or it drops up to 70% exempt or 30% is only assessed.
Now, back to what you said before in tying this in, and typically to Ron's question, Centrelink don't care whether it is $500,000 in the bank or a $500,000 investment property that's owned outright.
Yep.
because what they do in the background, they apply their quote-unquote deeming rates. So it doesn't matter if it's 500 grand Bitcoin, cash, gold, your investment property.
It's a financial asset. It's a
shares in
financial
CBA.
asset.
Yeah.
Yeah.
So, but there's no other real, like, just what are probably the things that Ron would check if they did sell this investment property?
Oh, yeah, lots to consider, and we may not have all
now
time
if we
today,
move
but
into minimising tax, particularly if they are still working or one of them.
yeah, so again, we're assuming that they're in age pension status. A few things. If you sell an investment property, might you have to pay some capital gains tax? Yes. Are there some ways to reduce that? Possibly, but depends upon if you're working or not and your age. But that's important. Don't sell it for $500,000 and move it all in, and then a year later you end up with a tax bill. Make sure you plan for that or set that money aside.
So the timing is really important.
Timing and the calculations. And then in turn, are you eligible to contribute to super?
Yeah.
So up until the age of 75, you're eligible to make voluntary non-concessional contributions. But after the age of 75, the only type of contribution you can do is what's called a downsizer from your own home. So if Ron is 76 and looking at this, might be a great idea, but he may not be able to with the government rules.
I just thought, I wrote down number 5, what Centrelink also deem as an asset that we may have forgot.
Okay. Yeah, I'm ready for it.
Yeah. What if mummy or daddy wants to give some money away?
Or gifting. Yeah. Gifting, yeah. Up to 10,000 in 3 out of a 5-year period. So you can't do 10,000 every year. You can do it 3 years over 5.
Yeah, cool. So anyway, I think that's probably answered what Ron needs to know. And it's probably more, I would say, Ron, particularly if you already have superannuation and you're looking at this pension and there's a few moving parts, maybe you or your spouse is still working a little bit, it might be a flashpoint for some personal advice.
Yeah, and at least a conversation. Hey, a 15-minute chat, am I missing anything here? Oh, I didn't realise I could put money in to save on the capital gain, or I didn't realise I'm not eligible to contribute. Is it the right decision or not? It can be personal, but often it's a case of I might be moving an investment asset that's in a personal taxable environment into a tax-free income stream, tax-free for potentially my kids to inherit down the track, but also in retirement, income's important. And property is great. Lots of wealth is created through property, but often it's a low income or yielding asset. It might be generating 2 or 2.5% a year after all of the costs. Perhaps inside of super we're getting a 5 or a 6% income from that, that it might be, let's reassess that property. Is that fitting its purpose in our retirement asset pool?
Love it. Well, my name is Glen James, joined by Martin McGrath, financial advisor from Financial Edge Group, and you are listening to Retire Right.
This is a podcast that will help you plan and execute one of the biggest moments in your life. That's retirement. You'll learn how to set up your finances in a way that benefits you, your lifestyle goals, and keeps you in the know within this complex world of money and investing. Your host is Glen James, former financial advisor, author, and host of the popular Money, Money, Money podcast. Glen is joined by experts in various fields around the topic of retirement in Australia. Any advice in this podcast is of a general nature. Full details are in the show notes of this episode. You only retire once, so retire right.
Okay, Lynn, with all the craziness happening in the world, is it the best time now to change superannuation investments to very low risk and cash instead of the high risk categories? Any thoughts, Martin?
My thought, first thought was, which year was this written? Because there's lots of craziness that's happened over the last 5, 10, 20 years and 50 years.
I think I commented in the group that I think craziness is baked into life.
That is consistency. And unfortunately, surprise, surprise, there's going to be more craziness in the future. Yeah. So should we be making short-term decisions with our long-term money? The answer is no.
Yeah.
It was a case of, I've got some cash in the bank and I want to buy a new car in 3 months' time. Should I leave it in cash? Yes, probably. But if I'm retired and I'm 70 and my retirement nest egg needs to last me for the next 10, 15, 20, 25 years, what's happening next week or the month after shouldn't be a concern. I mean, you can be conscious of it, but it doesn't mean we need to make a change. As long as you've set up your income stream with the long term in mind. And I'd be concerned around shifting something now to then go, well, I'll want to wait for it to drop and buy back in, that's unlikely to be timed very well.
And what I would probably draw for Lynn, if this is kind of Lynn's age now, down here at this axis, and then in the future could be age 60, 65, 70, and I've just put them as flashpoints of, it could even be 67's a flashpoint, but I'll keep it 60, 65 and 70. And we'll assume Lynn is 50 or less. She doesn't, certainly from that little blurry image, doesn't look like she's much more than 50s.
All women look 21 years old to me.
You're right.
Yeah,
you are.
It's hard.
Yeah.
Yes.
So given Lynn is still in her early 40s, what we need to understand is if I draw this line here as a volatility in a portfolio, over time it increases. That's really bad. I shouldn't use that color. I'll just do that again. If it goes like that, that's just a balanced option. And if you zoom into right now, and if we said it was just sawtooth, like really crazy right now, we don't want to react based on here when we don't need the money for at least 7 years anyway.
Yeah.
So we always have to, if in doubt, zoom out. I'm going to get my team because I want to do some like stickers.
Bumper
and,
sticker,
and a t-shirt and hat. Chill out, zoom out.
Yeah.
Because that's what we need to do. Often when we hear with everything happening in the world, if you're asking the question, it's generally too late to act if you are one to try and time investing.
Yeah.
That's just a rule of thumb. So, but what we can do, Martin, as you'll likely agree, when it comes to our risk profile, if Lynn was a high-risk investor, over time her portfolio might look like a really jagged sawtooth, right? Which Lynn might not be comfortable with that. But how can we get an investment that maybe is less volatile so it just smooths the ride out a little bit more?
There's a few different things we can use. You need to make sure the risk you're taking fits with your sleep at night factor. Because history shows the more risk you take, the more reward you get in the long term, but not in the short term. Yeah. And that's the zooming out thing. So whatever your investments are set up at 50, at 55, 60 or 65, they've got to be set up with the next 20 years in mind. Yeah. But what we like, and we've done an episode about it, is considering some buckets, ensuring that, okay, what is the money I need? Again, in this case, if Lynn's in her 50s, it is a set and forget. Well, I can't touch it till I'm 60 plus anyway. I've just got to let it ride. But if it's a case of, okay, I'm living off that money now and I'm worried about if it goes down next month by 5%, is that going to ruin my whole retirement? Yeah. We can and should start to segment some of our super.
And often with this question, people are thinking short-term tactics where we need to just kick back to our long-term strategy. So we're not making a short-term market decision based on a Trump truth/tweet today.
Yes.
We're going, no, over the next 10 years, what do we want to do? We understand that, markets move like the ocean, all that stuff, and we just have to zoom out, chill out.
Yeah.
But yeah, good question, Lynn. Okay, Natalie, thoughts on this strategy? Post-mortgage payout in approximately 4 years, Natalie will be 61. So we're in our, call it mid-50s now, 4 years to go with our mortgage. What should we then do with mortgage payments? Low super, don't want to end up with a paid-off house and no money in retirement. Not planning on retiring until 70. So there's a 15-year runway with Natalie's plans here, potentially. And we've talked about this a lot, but the question is, debt-free, mortgage-free, what next?
Yeah.
But there's another element here, which is the most juicy thing in the world to discuss. Do we put the mortgage on minimum payments and smash super to save on tax over the next 5 years, and then we do the shuffle, razzle, dazzle? Yeah. I mean, this, Natalie, is the absolute question.
This is what gets me excited. This is it. So you're 100%. Anyone in their mid-50s is in similar situation, Natalie, often are going, well, I want to be debt-free. We all want to be debt-free in retirement, and we know that is key to do so for homeowners. But often the shortest way to get there, ironically, is not just paying down your debt. Because if it's a case of I'm not topping up super, whether I'm self-employed or not, I'm going to do bare minimum super until the debt's gone, and then I'm going to wake up and figure out what to do, which is Natalie's question. And it is key. We want to be debt-free in retirement. But perhaps the better strategy is to, like you said, let's tone down the mortgage repayments. If we're putting an extra $1,000 a month on the mortgage, perhaps we can sit down and look at the numbers, either pay someone to look at the numbers for us or listen to many of these podcasts and episodes that might tell you, well, if that's $1,000 after tax, that in fact might be $1,500 or $1,800 before tax that perhaps could be going into super and saving you 20 or 30% in tax. Now, the advantage is that's going to compound and grow pretty aggressively in your super, but the mortgage is not going to go down as fast. So it's in the case of, maybe in that case, rather than going no super till 60, debt-free, but not have much super, versus, maybe the mortgage takes to 62 or 63 to pay off, but that day you end up with an extra 50 or 60 grand inside of your super. The tax is always going to, until they change the tax rates, going to pay off and you end up with more bang in your buck. We've discussed that in detail very often. That's before adding in TTR strategies at 60 and how you can have your cake and eat it too. But that's probably, again, deserves its own podcast, which we've done before. But that would be my kind of thoughts.
Do you want to flag that? And we will, next time you're up here, maybe next month when you're listening to this, everyone, we'll do an episode of a TTR
and
revisit.
Yeah. So TTR stands for Transition to Retirement Pension, which is accessing some money from the age of 60. But let's do that separately. So my encouragement to Natalie would be, again, well done. You're on the right path, but make sure that the strategy works out longer term. You're getting thirsty, Glen.
I tried my new water bottle's got a child-proof cap on it, and I just couldn't get it off.
This might be the last Retire Right episode ever recorded.
Yeah, and it's not water in there, if you know what I mean.
So that would be the go. I think perhaps Natalie, again, well done, but let's reassess the strategy. Let's consider this, should I salary sacrifice instead and reduce the mortgage repayments? If that's the case of going, no, I don't care, I don't worry about if I can save 10 or 20 or 30 grand in tax over the next 4 years, I just want to be debt-free, well then that can still be done, pay off the home loan, and then the 3 grand a month or whatever it is that's going in your home loan, you could consider still doing some salary sacrifice into super at that point. You could still do some voluntary non-concessional contributions into super at that point. Both of those answers include loading money into super. Over the age of 60, where should you be building your assets and wealth? Definitely inside of super, because that's the lowest tax rate you're going to get.
Can I ask you a question to see if you think it is relevant to this and doing retirement planning for north of 55s? And I've just drawn this diagram because actually yesterday or this week on the Money show, we had a similar situation where they're in their early 40s. They had just sold an investment property. So they had $500,000 in cash, pretty much offset the mortgage. So they now don't have a mortgage. So the exact same thing, but 20 years, 15 years, 5 years, however, I don't even know. Natalie, we said that she was in her 40s as well, right?
Yeah.
So my kind of question was, once we get to a critical mass in our life, particularly in that wealth accumulation, the house is the big thing that, let's decide what we're doing with the house. Are we renovating it? Do we want to upgrade because of the kids and all that stuff? Then we plug in our financial strategy to that as the main rock. Yep. Assuming you want to own a house, you live in it, rather than doing what I'm doing, I just rent and own investment properties and do all that. So my question is, Natalie has her house, and I put this question mark here to potentially help her answer this, and this will help her answer I don't want to end up with a paid off house and no money in retirement. What are the plans with the house at age 61 or 60 or 70? Are we planning on keeping it and happy to leave feet first in a box?
Yep.
Or is there a downsize at one of these flashpoints? Now, I would hypothesize if, I want to work till 70, I'm happy to live in this house and all that, but I think one day I'll probably downsize. Well, I'm thinking, pay off the house now, and those, I don't know, 9 years in your 60s, just pump super, just can't wreck it, really. Do what you're most comfortable with.
Yeah.
And there was a comment in the group where someone was in agony and then they put, well, Glen said, this is how crazy money is. Glen said that he'd never met a client in their 60s who regretted putting too much in super. And I said, absolutely, I never met someone who said that, but I also never met someone who said we regret paying off the house.
Yeah.
So it's like once you get to a critical mass, you really can't wreck it.
No.
There could be some fringe tax savings and what do they call it? Like the
like
arbitrage. Thank you with interest rate and super returns and tax. But in the main, Natalie, do what you want.
Yeah. If this sounds
is that
all
too
hard.
loose?
No, I don't think it is. And that's
like,
where and a 10 or 20 grand is a lot of money, but also if that's not going to help you sleep at night, your mortgage is going to be around till 63, then don't worry about that 20 grand. Yeah. Particularly if you've still got 9 years after that to build that super back up.
Yeah.
But ideally it's building up inside of that super environment.
Thea, I'm looking for help to review our super performance. Sounds sexy. My husband and I have an individual wrap super fund through our financial advisor. Where/how do I find other fund benchmarks to compare it to? I suspect we're paying more in fees than industry funds, so I want reassurance that this is being compensated by additional performance. I want to do my own independent comparison and not just rely on the FA. I actually made some comments on this, but what are you saying to Thea? Like if Thea was your client?
Yeah, I welcome it. I think in two parts of, there are public websites where you can go and see what all the industry funds or all the My Super funds have returned. So they're there. So the numbers can be compared. I think a few parts is one, making sure we're comparing apples with apples. Yeah. As we know, we've done deep dives around that, asset allocation. So industry super fund X might say they're balanced, but what does exactly balance mean? How much is in growth and how much is in defensive? Because they're not consistent. The label doesn't always describe what's underneath the bonnet. And so therefore your fund might be 50% growth and 50% defensive. If you're comparing that with something else that says balance that's 80% growth and 20% defensive, then yours might look like it's worse, but that's because they're taking 30% more risk than you are. Yeah, two, for us, one of the things that we talk to clients about is, well, what do you want your super fund to do? Do you want just the lowest cost, simplest option and then let's go with the low cost? Or do you want to have some more bells and whistles and you'll pay for it? Do you want to have direct shares? Do you want to be able to do term deposits? Do you want to have overseas investments? They may or may not perform, which is its own discussion, but there's a price to pay for that control and transparency. And therefore, if fees are the only thing, well then maybe we don't need to have some of those items. The other part that I'll throw to you is, again, depends if we're referring to fees just from the super fund. I think they mentioned what wrap they're on, but the wrap might have their own fund and or the advisor might have fees. Yeah. Advisors charge fees. That's how they run a business. Sometimes those fees are, yes, about managing your super, but often a large part of a great advisor is helping you manage your overall world and contribution planning, tax planning, doing projections for you, preparing different scenarios to map that through. They may charge that to you through your super fund, but I would then often suggest let's separate those fees or isolate those fees because you're comparing, okay, well, I'm paying my wrap account and that includes these fees to my advisor, but the advisor's fees aren't to get you an extra 1% most of the time. They're to hold your hand through all these strategy items and planning. So if you're comparing that versus something off the shelf, yes, that may look cheaper because they're not giving you any help or support or anything like that as well. To make sure that, again, are we comparing the super fund fees with the super fund fees, or we're comparing my super fund, which has my advisor fees in there as well, versus not?
So my own doodling comments, and I won't repeat what you said, you talked about the asset allocation. So we want to make sure whatever, and I've just drawn a wrap platform. Mm-hmm. So that bottom bench is we'll call it the platform, where the investments stick on. and or sit on. And those investments, Australian shares, international shares, might be some property and cash, could be very different investment options. There could be just the one option, whatever. Within the investment option, you talked about asset allocation, that we have to make sure it's growth versus defensive is the same. Yeah. But if you want to go further, you need to make sure with the industry fund that you're comparing to that their asset allocation to growth, sure, it's 70 and yours is 70, but within that allocation that you've got 30% Australian shares, you need to make sure that within that super fund that the asset allocation within that growth matches.
Yeah, true. Yep.
So it's very, very hard to compare superannuation funds and investments without understanding the broader asset allocation, but within the growth and defensive.
Right. Yep.
So that's number one. You're right with the fees. There will be a fee that the platform charges, which doesn't go to the financial advisor because that's illegal and has not happened for over probably 20 years now. So I want to dispel that myth. And then if, for example, the Australian share portion was an index fund managed by Vanguard, there's a fee for that option that goes to Vanguard. If the international thing is managed by Perpetual, there's a fee that goes to Perpetual. So then the fees for the investments work out to be a fee. None of it goes to the advisor. It literally goes to the fund manager. Within that, and this kind of speaks to the asset allocation, you want to make sure that the investment style is the same as well. If you have a wrap account and your financial advisor has a model portfolio in there, and I'll give you an example, there could be a portion of Australian shares, micro or small cap, that's actively managed. There will be a higher fee for that actively managed portion, where you might look at an industry fund or a pre-mixed portfolio where the whole portfolio is indexed. So again, another layer of comparing apples with apples. Then you'd pay. Now, you could set up a wrap account and have the investments on there. Some of them are direct to consumer. You can do that yourself. Then if you choose to pay an advisor or a portfolio manager to work out what goes where and what not, that's an extra fee that goes to the advisor. But as you touched on, it's not just investing. And you can research everyone. Just Google Vanguard Advisor Alpha. There is data and Russell did it as well. There's actually data that says, and this is where people just light their hair on fire and can't get their head around it, by paying advisor, having someone in your corner, you will get probably a 2 to 3% better outcome because they'll help with the behavioural things and won't be like our first questioner, Lynn, who said, should I move my investments to low? Well, if you're paying an advisor, they'll say, no, Lynn, this is why, and you wouldn't do it, and you wouldn't try and time the market and lose.
And I think just jumping on that Vanguard report, and just you worded it correctly there, but it's the Vanguard's not saying an advisor is going to get you an extra 3% return every year. They're saying they're going to get overall result because they can optimize your tax, they can ensure that you're invested appropriately, that investor behavior is ensuring that you are investing regularly and not making short-term decisions. Because there was a whole bunch of studies and reports that came out during the COVID period around how many non-advised clients actually made changes to their super funds and at the wrong time in the cycle moved to the defensive option. Whereas perhaps if they had an advisor who could pick up the phone and have a talk to, oh, okay, no, yeah, you're right. No, thanks for reminding me of that. No, that's fine. I won't make a change now. And all of a sudden, when the market recovered within 4 months, they're back to where they were, versus if they were at home by themselves in front of their laptop, they might have made a silly decision.
Yeah. The other thing, and you did touch on it, but we'll just bring it home. Sometimes I pay a higher fee because I need something and I can't get that something from a lower fee. One of the things that comes to mind could be around estate planning. I want some more transparency of my investment portfolio. It might be that, and you'd probably see this more than the average bear with your clients in terms of, like, we don't run everything in our life, like what's the cheapest, but there could be, like if Thea had a portfolio that's in super on a wrap and they had some investments outside of super on wrap, there'll be internal packaging discounts.
Yeah.
So you really can't
Compare.
So anyway, what I would say to Thea, if we cut to the chase now, you want to do your own independent comparison, look at the investment report from your advisor, just start with overall asset allocation. Number 2, you could ask them, hey, could you run a benchmark report to the most equivalent matched benchmark that you can find for the portfolio that we're invested in? Yeah. And even, I'll just have a look. I got an email the other day. So in my self-managed super fund, maybe I deleted it. I just use Vince's Life Sherpa in my own self-managed super fund. He sent a performance update.
And while Glen's playing out, what he means by benchmark is...
Yes, explain that.
If we're comparing a balance versus a balance, making sure that there's a benchmark that averages all of the true balances. So if you're comparing how my Aussie shares did versus my international shares, the Aussie share has its own index, the international has its own index, the international emerging markets has its own index. So you're comparing like with like. And so there are probably 50 different benchmarks in Australia measuring all different things. So how well do I do? Well, compared to what? If it's against a term deposit benchmark, that's going to look very different to a conservative benchmark or a high growth or an international share benchmark.
So, for example, a real example is the cash rate at your bank. We'll do mortgage.
Yeah.
If you've got a mortgage and you're paying 5.8%, the benchmark is the RBA cash rate. Yeah. To be fair, what is it, 4.1 or something? What is it at the moment? You should know.
4.1. That sounds good to me.
I'm just going to fact check myself live. Reserve Bank of Australia. No, it's 3.6. I don't know where I got.
Okay. Well, maybe we're paying too much.
Mate, no, I was actually thinking term deposits, maybe.
Yeah.
I don't know, whatever. So the actual cash rate that the RVA charging.
Yeah, that's the benchmark.
That's the benchmark. Your home but we know that the bank are making a profit between the cash rate and what you're paying.
Yeah.
You could do it the other way. The benchmark for the
rates,
term deposit or the savings rate, it will be less than that benchmark because they need to make the spread.
Yeah.
And just while I was doing that, as an FYI, everyone, if you do listen, my phone was buzzing, that's why I got it out of my pocket. It was a New Zealand number. We're doing a live show in New Zealand on the Wednesday night, 18th of Feb in Auckland. I'm doing a money live show. So if you want to come along, I'll put tickets in the bio on that. So I'm just looking at this investment report that Vince has set through for my investment. Okay, so for example, in one of these reports, I don't want to dig too deep. The portfolio that I'm in, they've got a 3-month, 1 year, annualized, 3-year, annualized, 5-year, and a 10-year. Tells you the return for the portfolio. It tells you the components of the portfolio, but also at the top of his newsletter, it also has a heap of the indexes. Yeah. Now, I don't have time to find benchmark because he does have stuff where he's benchmarked his portfolios to VDHG, but it's just got here, the S&P 500 for that same date range, it was 15.28%. The Australian ASX 200 over 10 years was 9.31, where the portfolio that I'm in, if I just invested in the ASX over the last 10 years, 9.31. The portfolio that I'm in, 11.04. Yeah. That's more of a diversification play.
Yeah.
So benchmarking, it is good to know.
Yeah.
There's a funny thing I used to say, and it annoyed people online, and I would say, after fees, an index fund will always underperform the index.
That is correct. Yeah. Because if they're getting the index, it's always going to,
Well, you'll get the index, but you've got to pay the fund manager. So you use index investing and it doesn't outperform the index, but it's Not, it's a bit tongue-in-cheek.
No, again, we'll move, other than I'll add it as well, is like we have some portfolios we run for clients and we don't run them in-house. We use external experts as well. But one of them in particular, over the last 5 years, it's returned about the index. But like your little wave graph before, the way that it's done that is very different to the index. So that when the market's booming, it's not going as well. But when the market's dropping, it's substantially protecting the downside. Now, if a sleep at night factor, if you've got your assets in retirement phase, and if we're talking about some big dollars here, you might be happy to pay an extra 0.25% for that sleep at night factor to know if I wake up and see the news and says the share markets are down 10%, mine's probably only down 3 or 4 or 5, that's actually okay. That might be fees well spent for someone. For someone else, it might be, no, I don't care, let it ride. But for many people, paying that money, why are we paying that for? It is part of what you're getting. That's not just that the number over the last 5 or 10 years tells the whole story either.
I would also say when you are doing comparisons of returns, particularly for growth assets, please, please, please do not look at the 12-month or even 3-year. We want to see, because we're investing money into this portfolio, not for the next 12 months or what the last 12 months did. We're investing this for the next 5 to 7 years. It's a balanced or growth portfolio. So we really want to just compare, because within that, the portfolio managers may have some strategic asset allocation plays and tactical stuff and all that stuff where, our portfolio looks like a dog over the last 12 months, but we're not investing over the next 12 months or the last 12 months.
We were positioning for the next downturn and they just made the decision 2 months earlier, and it's going to pay off when that happens, kind of thing. So.
Yeah, no worries. Oh, actually, because I just said to Vince, I can't find it. Do you have a benchmark for the Denali 80 versus VDHG handy? He said, I posted it in the morning, in this group in the morning. I'll tag you when I find out he's out and about. So all that to say, if you go to the advisor and you're just asking for some benchmarking out of curiosity, if they don't want to provide it or give you BS, maybe there's a bigger question there.
100%. Yeah, no, and that's fair. If someone asked me, I'd be more than happy, and the advisor should be sharing it.
Yeah.
Even if the explanation of this is how it all fits together. And it would go to them, hey, can you compare? Most advisors would have software they can compare it against 50 or 100 different super funds.
Yeah.
Hey, my friend's got this fund. Can you add and compare it and show me?
I don't want to get too technical or even defend funds and portfolios that are actually dogs, because they exist. But there could be a reason, for example, and it's all about, they call it the risk-adjusted return.
Yeah.
So it's like, well, okay, our portfolios, they're actually like 0.5% or 1% less than the benchmark. However, there's been less volatility.
Yeah. So beta, like often that's referred to as beta. So how much risk did we take to get that return? So if one fund over 10 years got 10% and they took 100% of the risk, but another fund got 9%, so they've missed out on 1% return. But if they've only taken, to be extreme, 50% of the risk, well, on a risk-adjusted return basis, that's actually a much better fund to be in. They've effectively got an 18% return on a risk-adjusted comparison. Now, this is a generalization. If I'm in my 20s and 30s and I can't access my super for many decades, the risk-adjusted return might be less important. But if I'm in retirement phase and close to that, I might not want always just the highest alpha being the highest return. I might want it to be factored in for risk-adjusted, particularly if an advisor's done some modelling and shows you, hey, you can achieve all your retirement goals with 7%. Well, why would we take the extra risk to try and get 8 if you don't want to? Yeah. That's then a personal decision. Yeah. But that's why it's not always.
So this is where he was talking about VDHG and whatnot.
Yeah.
Full disclosure, Vince licenses this podcast. Full disclosure, I invest in his product. Full disclosure, if in doubt, assume every time one word leaves my mouth, it's an ad. Just assume the worst anytime I talk. Over 10 years, VDHG, or the managed fund equivalent, has delivered 10.47 over 5 years, 9.93 over 10 years. Over 10 years, their portfolio has delivered 11.57 over 5 years and 11.04 over 10 years. Don't know if you worded that right or I'm reading it wrong. If you induct the fee for Open Invest, because remember we talked about that platform fee, it delivers a net return of 10.92 over 5 years and 10.39 over 10 years. So we know that that's higher than the VDHG.
Yeah, by about 0.5%.
After fees. More importantly, especially for higher rate taxpayers, 7.95% of that 10-year return came as capital growth compared to Vanguard's 3.87. This makes a big difference to the after-tax returns. The Life Sherpa portfolio has delivered lower volatility, which is actually just what I said before. 9.44 compared to 10.4 for Vanguard. Now, that's very technical and geek out, and don't let nuance wreck a good Facebook discussion. How dare you? But there is often more than the rack rate of what's the best return, what's the cheapest fund.
Yeah. Yeah, and if we've had clients come and say, this other thing my friend's in, it looks like it's returned more. I go, yeah, actually it has returned more.
Yeah.
But let's explain why and if that's appropriate for you or not appropriate for you. Because, and it's easy to look in the past and go, I would have been comfortable with that 18% versus the 13 I got. Cool. But in 6 months when that one's minus 20% and yours might be minus 10, would you still be as comfortable then as well?
So for me, and we do need to move on, but I don't chase the best return year on year by looking at tables. I look for long-term track record with a portfolio and fund manager. So there might be a next year, if you compare the 10-year return of the VDHG versus the 10-year return of the portfolio that I'm in within my self-managed super fund, if VDHD did better that 1 year, I'm not moving because I'm happy with how the portfolio set up, the transparency. The tax one was an interesting one. Sure, it could be interesting as well for superannuation, particularly the breakdown of income and growth. But with after-tax money, it's more important because the growth, you're not getting taxed on the portion that's income each year. It's the growth, so it's actually better for tax.
Yeah, you're not paying, it's tax deferred, or it's at a capital gains rate, which is going to be discounted versus personal. We said we move on, but I'll focus as well. I think the other important, and I can call this out for you versus yourself, is that someone go, Glen's very smart. Why isn't he looking after his money himself? In the fact that you're also self-aware of, yes, you could be doing that, but part of having it involved with someone else that you know and trust is that your personal bias is also then removed versus going, I know that one's underperformed, but I really like it, so I hold on to it. It's important to go, hey, I'm smart enough to know that I can out and should outsource some of these important parts of life.
Yeah, 100%. Because for me, I don't want to be looking at my portfolio every week, every month. I just know this is what I want, strategy for the long term. Let it do its thing.
Yeah.
So much for that 5-minute question. Okay, we'll be back right after this.
If you're after personal financial advice, don't get it from a podcast. If you would like help based on your own personal situation, head over to retireright.com.au, click Get Help, and we'd be happy to introduce you to one of our trusted professionals. Our panel of vetted financial advisors and mortgage brokers work with people all over Australia, so they can connect with you wherever you are. That's retireright.com.au and click Get Help.
Okay, let's finish with this today. Mike said, wondering if anyone has advice, tips on long service payout, please. When I retire, wow, I'll just have over 8 years of service, so can only take pro rata payment. Is there anything that helps re-taxation?
Pro rata, okay. The 8 years is throwing me off a little bit. That might be a state-based
I have
rule,
just over 8 years of service. That could be one of the building construction things.
Yeah,
you know, those,
and often they're state-based. So I'll talk more broadly about this, and then we can come back a bit to Mike's situation. So I work for a company, and this might be the same word, that's long service, time in lieu, annual leave entitlements, those kind of things. That often, okay, I'm going to retire next month. You might have a chat with the work or not, and they go, you've actually got 3 months of entitlements or 8 weeks, whatever it is, to use. do you want us to pay that out as a lump sum? Or some employers, most employers will say, do you want to take that leave over how many fortnights or weeks that ends up being? Is there any difference? Short answer, yes, there's some pros and cons. By taking it on a more regular basis, it gives you some cash flow that's the transitions you to retirement. But while you're taking that on a weekly basis, you're often accruing more entitlements. So every month of leave entitlement you get, you might have accrued an extra 1.8 days or whatever it is, and all of a sudden you turn your 3 months into 3.5 months. So you keep accruing as you go along. Super guarantee is payable on that as you go along as well. So super still being paid. Sometimes you can salary sacrifice it, sometimes you can't, but generally you can still salary sacrifice some of that money. So they're all the pros of taking on a regular basis over an extended period of time. Sometimes you can take it over even half pay or pay me half, so it extends it further, and also might push into a new financial year when you're on a lower tax bracket. So plenty of positives in that respect of taking it over time. Where might you want to take the lump sum instead? A few things come to mind of one, well, if you need the cash, if you need a 20, 30 grand cash because you're going on a trip next week, you'd take it, we'll take it. Two, the way that Centrelink will typically, if you're on the age pension or something like that, generally, if you take that over 4 months, well, you've got to report, hey, I've got income for 4 months, and every 4 months or every fortnight, you're going to get less age pension because you're still earning wages. If you take your 30 grand lump sum, well, then that fortnight for Centrelink, it's going to penalise you because that's a lot of income. But the fortnight after, you say to Centrelink, I've retired, I don't have any wages anymore. And therefore, your age pension can and will often be substantially higher. But you lose, you don't have the entitlement to salary sacrifice any of that payment. So you get that 30 grand, you get hit with the tax. It doesn't stop you from making a personal concessional, but you can't often salary sacrifice it. You don't accrue anymore as it goes along. And then sometimes some of those components super guarantee doesn't apply to, but in most cases it does. So I think in the past, I might even put a table together, and if we feel like we can dig that out somewhere or share that somewhere, I'll try and where that is. But
you can get it to me within the next 2 days. I'll overlay it right now.
Yeah. I think unlikely we'll find that later. Let's Google that later, or we can put it in the Facebook group later once we find that. Generally, preference is probably take it fortnightly, but there are some clear examples there as to why the lump sum may be better in certain cases.
Yeah, so I'm just, the more I read this, I don't know, it just throws me, so I can only take pro rata payment. So pro rata payment, maybe he's saying the amount is so big, they're going to cash flow it.
Or generally, and again, long service leave, from my understanding, it can be a state-by-state rule that you generally get full long service leave entitlements after 10 years. Yeah,
but I thought as well, like the National Employment Contract Law was national.
It was national.
Either way, what I would generally say is if you're nowhere near Centrelink, if you're nowhere near needing that
lump sum,
if it's all pretty good, and it was age 60 that, I want to retire, we've got more money than God, want to retire, blah, blah, blah. I've got 6 months of long service leave. In the ordinary course of business, I'm saying, don't say, give me my 6 months as a cash payment. Just go, I'll just go on annual leave and still be an employee for the next 6 months.
Yeah.
Asterisk.
That's generally. And then actually, I had last minute as well, the other thing I couldn't recall before, but now came to me is, another benefit of taking a lump sum is you can turn around next week to your super fund and say, I can now go to full pension status because you have ceased a position or retired. Whereas if you do take it over 6 months or 12 months.
Yeah, but if you got cash in the bank, this is where the strategy comes in. You're like, we won't pull that trigger until the long service ends in 6 months because we'll still be an employee, get potentially super. Yeah. And also, this is another thing, if it does tick up, so it crosses an annual threshold of index, your wage might increase, so you might actually get more.
Yeah, and if the last 2 months of that falls in your financial year, you're probably not paying any tax on it as well.
Yeah.
So, lots of reasons to go one way or another.
Lots of reasons to get advice.
But, the right answer is depends upon circumstances that got nothing to do with the actual long service leave.
All right, we'll leave it there. Thank you so much for listening today, everyone. Sorry if we outstayed our welcome a little bit, got stuck in the weeds there, but here we are. My name is Glen James, joined by Martin McGrath from Financial Edge Group. If you have found this episode useful, why don't you send it to a friend or family member? And hey, if you're on YouTube, yes, I'm looking at you. So many people watch us on YouTube and they don't click subscribe. Why don't you subscribe and help us out?
If this is
because
good,
we're on the new YouTube now.
The others are going to be even better.
This is going to be a cracking year. We're putting so much effort in this year. Anyway, thanks so much for watching and listening. Of course, if you do listen to audio only, we hope that it still has been beneficial. We'll see you next week. Remember, you only retire once, so
retire right.
Yeah, baby.
Any advice is general financial advice only, which does not take into account your objectives, financial situation, or needs. Because of that, you should consider if the advice is appropriate to you and your needs before acting on the information. If you do choose to buy a financial product, read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs. Simo Interactive, Pty Ltd, and Glen James are authorised representatives of Money Sherpa Pty Ltd, which holds Financial Services Licence 451289. Martin McGrath, Financial Edge Group, and its employed financial advisors are authorised representatives of Synchron Advice, AFSL 243313. Opinions or comments from any guest on the podcast are theirs, and not those of the hosts, the publisher, or their respective licence holders.